Hello, thank you very much for having me here today. It's a pleasure to talk to, especially students and lecturers. It's been a long while, since I was back in school. But I mean, regardless, it's good to be talking virtually. I know that I'm supposed to talk for the next 2 hours, but to make it more interactive, I think I'm only going to be presenting maybe about an hour and ish or so. But I definitely would love to actually share more from the audiences today to see if you have any specific questions or if you want to ask anything. I think that would actually give you more value than just me talking. Communication is better if it's two-way rather than one way. Maybe let me just share my screen. One sec.
Ask Muna if you can start presenting.
Yeah, sure.
Okay. All right. Just to make sure, can everyone see my presentation slide?
Yeah, yes.
Okay. Great. Let me just bring you through. It's flipping, right?
Not yet.
Oh, is it flipping right now?
uh, no. Maybe you can. Yes, now. But maybe you can put in the presentation mode because it's slightly small though.
I see. Okay, got it. Yeah, I was actually on my presentation mode, but
Eh.
somehow,
Okay, so we are not seeing the presentation mode of the
yeah,
of
yeah.
the deck.
Hold on, let me share. Sorry. Let me try to share my whole screen then. Oh, you can see my presentation mode, right?
Yes. All right. So that's great. Okay.
Okay, sure. Understanding that there's a lot of students here, there's also lecturers, so I'm going to try to keep the topic a bit more layman, so that we don't go too much into the technicalities. But before we go into the the actual topic, as in to talk about what are VCs and what do VCs do, maybe let me give you a bit more insight to who we are as a firm, and I think by doing that, it would allow you to have a bit more insight on how VC actually works. As a start, Vin Capital, we are based out of Malaysia, but we have a small desk in Singapore and Bangkok. Our intention is to launch into Hanoi in Jakarta as well to cover the whole region. Typically speaking, I think as for right now, a lot of the VC firms out there are looking at investing across the region, which is why it's always good to have local footprint, local presence across the region, and that's the same with Vin Capital as well. We are born out of Malaysia. Our HQ is in Malaysia, but that doesn't stop us from looking at opportunities across the region because this is where we think that Southeast Asia as a market has a huge potential rather than just looking at one single country. I think Putri has already shared my background, so I wouldn't want to go through again. And these are some of the companies that we have invested from Vin. We have six of these portfolio companies we've invested. Obviously, I think most of you would probably have heard of, or at least seen Parsons signboard here and there, or you had heard of the advertising ad on radio channels as well. Droppy is another Malaysian company, and ePost is like also another Malaysian company, but they are based out of Sabah. So that's like the first ever startup from Sabah that got funded by a VC. We also have investments in other countries, Traveler from Indonesia, Pomona from Indonesia, and Velotrade from Hong Kong. So all in all, for us, we look at companies or technology firms that are across the different borders and jurisdiction. Um, just also to share a bit about some of the companies that we've invested. Travelio, I'm not sure if you're well versed with the funding jargons of VCs, but typically speaking, as a startup grow, there'll be larger and larger funding rounds that startups would actually raise to get the right partners, get the right investor to support them in their journey to grow the business. For example, Traveler from Indonesia, they raised about 80 million US dollar in one of the latest round that they did in 2019 where it was invested by one of the government fund or several fund from Singapore or Pavilion Capital, and also by Samsung from Korea, to actually expand the business across Indonesia. Because Travelio, if you go do a search on them, they are always compared to or you're from India, or they're being compared to Airbnb as well. But the biggest difference is that Traveler, we manage the apartments that sign up with us. So if any property developers in Indonesia, they sign up with Traveler, we'll be handling everything for them. So it's a tech platform that enables the traditional sector to actually expand on their capacity to actually serve the customers better. Of course, Carsome is the other one that we have invested, and hopefully we are making Malaysia proud by supporting this company. And for most people, you know Carsome as a company that buys your cars. If you're driving, if you want to change a new car and you have your old car that you want to get rid of, yes, then you can go to Carsome and sell the used car, and they will help you to sell it to your dealer to give you a best price. But right now, beyond just selling your own car, we are also helping you to buy your own car, buy a new car as well. Of course, it's still a used car, but we inspect them, we provide guarantees, we provide insurance on the cars that you can buy on a platform. So all in all, the company has evolved to become a one-stop shop for everything. If you want to buy a car, you can go to Carsome. If you want to sell a car, you can also go to Carsome. And if you're buying a car from Carsome, you could also get a loan from them as well. So it's a one-stop shop. They tap out everything for the whole process of the used car industry. And I think the most recent news that would excite us is the fact that they are now a unicorn. For those who are not familiar with the term unicorn, actually the only meaning it has is that the company is being valued at above $1 billion. When an investor invests into the company and they value it at above $1 billion, then that's what it means by being a unicorn. However, having said that, I think being a unicorn is a proud moment for most of tech companies out there, but it's definitely not the end for of the journey. Because at the end of the day, they are building a business, and essentially the next step for companies like Carson is to make sure their business can grow further and be sustainable and being able to make money for the investors. One of the other company that I can share from our end that we have invested is another Malaysian company that's called Droppy. If you are very familiar with the entrepreneur scene, you would have definitely heard of Y Combinator, which is an accelerator slash VC from the US. So Droppy was the second Malaysian company that got into Y Combinator's program, and they were invested by Y Combinator after that, and eventually they came back to Malaysia to expand the business. So right now, Droppy is also in Indonesia. So as a Malaysian company, they have managed to bring themselves to Indonesia and to expand the business over there. So I think what I'm trying to really illustrate here is that for us, for most VCs actually, we are always looking at companies that could expand from one market to another market, from one country to another country. So going into, taking a step back, before we zoom into VC, how do VC work? I definitely want to introduce um, a few options of how startups could actually fundraise. If you're running a startup, if you want to run a startup eventually, you want to know who are your potential funders, because there are different options that you can actually look for or you can talk to, but at the end of the day, it depends on what you're looking at. This slide is to generalize what are the type of funding that an early stage company, a young entrepreneur, when they're at the start of building their business or their businesses, these are the options that they have. We have grants, we have the equity crowdfunding platforms or angel investors, we have the P2P platforms that provide short-term loans. Of course, we have VCs, and definitely when your company is more mature, when your company is qualified for the more mature, the bigger boys, you can go for banks, or you can go for Malaysian Debt Ventures, MDV, for longer term financing. Just to illustrate a bit of the difference between the options. For grants, typically it's free. In other words, it's kind of a free money, but there's always a condition to it. And usually it's based on a disbursement structure, meaning you spend the money, you claim from you actually submit your expenditure record to the provider, and then they would reimburse your cost, the amount that you have spent. So guys like Cradle, guys like MTDC, SME Corp, they have or had they had programs where they offer grants to entrepreneurs, to SMEs who are at the early stage of building their businesses, where this grant becomes the source of their product development cost or the source of their R&D costs. So a lot of the younger startups who are not qualified to go for VCs yet, they would definitely look for grants provider like Cradle to support them. Duration of it depends on the program. And there are times where certain grants are more short term. There are also times where grants allow for a drawdown over the next couple of years. So it really depends on the program. And payback typically only happens, and like usually most of the grant providers don't expect a payback. But of course, there are certain programs where they expect you to pay back if, let's say, you become successful. Let's say you manage to raise more money from VCs, and some grants would ask you to pay a portion of it back. The intention is to provide more funding for future entrepreneurs who wants to build this company, so that the grant itself would never be depleted. And I think grant is a bit more sensitive in the sense where, because a lot of times the stakeholders are government agencies, ministries, which is why there's always milestones and reimbursement structure that is in place to ensure that you don't simply spend the money. If you get grant and then you're gonna go and buy a Ferrari, then that's a bad thing to do. Hence, most of the time they definitely need you to submit and a milestone reporting to make sure that you spend the money properly for your business. And also, to illustrate a bit more about the other newer options, angel investors simply are individuals who believe in you, who wants to support you as a friend, or we have this thing called the friends and family round, where you have your friends, your family members to invest in you at the early days to help prove your business before you actually go out to raise money from professionals like us. But on top of angel investors, we also now we have platforms like Pitching, CrowdPlus, etc. These are equity crowdfunding platform where you put your program, you put your idea up there, you put your business up there, in hope that Pitching and the likes of Pitching would be able to attract crowd individual investors who would invest onto your platform as equity investors. Meaning, all these individuals who invest into your business via all these ECF platforms, they would expect a return. They would expect to get money back when, let's say, there's a company, there's someone else who come and acquire your business. So they would expect a return of investment for the amount that they have put in. And these are platforms or options that is good for companies who are not qualified for VCs yet. Because overall there are different stages, and VCs typically look at slightly more mature stages. If I jump into VC, typically speaking, venture capital firms or venture capitalists, we look at businesses that is already in the market. Meaning, if a product, you have an MVP that's ready to either ready to launch or already launched into the market. What it means is that we see a track record of your business. We see usability of your product. We have a clear idea of the UI or UX. We have an idea of who are your users. There's a clear demographic that we can actually gauge gauge the market size. At the end of the day, VCs are also trying to make money. So we invest with intention to get returns. And that's why we would have a lot more structure in place to require reporting, to require updates, so that entrepreneurs can keep us posted on what's happening with the business. And typically speaking, VCs are active partners for entrepreneurs who are trying to grow the business. That's why for us, for example, when we invest, we would ask for having to sit in your board so that we can provide advice, we can work with you. In short, venture capital firms and venture capitalists, we think of ourselves as a business partner to entrepreneurs rather than just a pure investor, a pure shareholder, where we just put money and then we just take a back seat, and let you run the show entirely, and we just don't say anything. Of course, there are also some VCs who would just invest and wait for the returns and do not do anything else. But with most of the active VCs, active in the sense where we believe that our contribution to the company can add value, and it can and which means we can get a better outcome from the investment, then you see us getting more involved with the business to help grow the business as well. Okay. So I also did mention about briefly about the fundraising rounds. So for companies at different stage, you want to raise different quantum of money. You want to raise money from different stakeholders, different investors. And this is a simple slide to illustrate the different stages of your business, and who should you actually raise money from. So at the early days, when you have an idea, when you have a concept, but you don't really have anything to show yet, that's where I mentioned about friends and family. You get investors who are related to you, who knows you as a person, to invest in you. But when you have built something at the very basic, maybe an MVP or not even an MVP yet, you start to talk to angel investors, you start to talk to crowdfunding platforms, or you could join an accelerator or an incubator where they can help to further enhance your product, your business, your company, and so that you become more professional. And when you are good enough, then you can go out there to raise money from venture capitalists. Even within venture capital industry, there are different stages as well. Some would invest earlier, some will invest later. So it depends on the venture capitalist's investment strategy. And when you're mature enough, then you go for an M&A, you go for an IPO. This is where we call it a sustained growth stage, where business becomes more stable and you see more capital markets involvement, where you work with investment bankers who can actually help you to raise more money to do more corporate exercises. This is just to illustrate, reinforce what I just mentioned. For preliminary investment rounds, for the friends and family rounds, typically you're using the money for concept development, for early market research, to build your pitch, and also to test whether your product is good enough. For seed rounds, for angel investors rounds, typically speaking, you're at a stage where you're trying to identify a specific product for your market. You're trying to figure out which are the demographic, which are the market that you're trying to target, and then to also you use this to build your early team. Because especially for cases where there's only one single co-founder in the company, that's where an early round like this would help to give you the ammunition to grow the business to actually recruit more people to actually help you to grow your company. Then seed rounds, that's where depending on the type of companies or the industry, where we actually have a more concrete prototype, you have a more concrete product where we can actually start looking at dominating a market, looking at how to expand and grow further in the market. And then when you hit Series A, etc., that's where we look at expansion. When you look at into a new country, when you look at trying to expand into a new business model or trying to expand to a new industry, and eventually to do acquisitions as well. So what do we do as VCs? There are many things that we are known for. I think the title itself for this slide, it kind of show how intense our job can be, because no matter how we plan our time, there's never going to be enough to do everything that we want to do. A large part of our role as VCs is to actually help looking after the companies that we've invested into, especially if taking example of Venn Capital. We are an active VC. We take board seats in most of the companies that we invest into. We want to help our businesses to grow. We actually help them to talk to clients. We actually help them to help portfolio companies to talk to different stakeholders. That's where we spend a lot of time serving as a director, serving as to monitor our investments to make sure that they are growing the right path. Or if let's say there's problems with the business, that's also where we come in to be a firefighter, to help them to solve problems, to help them to address certain issues that they can't solve on their own. For instance, I have also been in a situation where, because of a employee of the portfolio company that went out to start a competing firm, that's where we have to talk to our lawyer to issue legal letters to make sure that the former employee of the company do not breach their non-competition agreement as well. So a lot of times we do spend on helping our portfolio companies to address issues and also to help them grow. But on top of that, we also help portfolio companies to do recruitment. We help our portfolio companies, for example, to look for CFOs or accountants or even corporate services as well, where we let's say if the company needs support on legal matters, we will also help to introduce lawyers to them. So all in all, we think of ourselves as a recruiter, as a corporate development arm for the portfolio companies, because most of the early stage companies, they do not have this. And if the co-founders do not have financial background, for example, they would not have the capacity or the knowledge on how to manage their financials, how do they actually do their accounting work. So that's where we help to recruit accountants, or at least to introduce accountants to provide them with the right kind of resources. Of course, we also do help as an advisor. We also do source or businesses, or I mean, to look for new deals that we can invest into. In general, we do spend quite a bit of time on being the 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 PR partner for our portfolio companies, to help them to look for opportunities, to help them to look at potential partners they can build, partnerships they can build within different markets they're looking at. But definitely, there will still be time that we spend on analyzing the business plans that we get, because of the fact that there's a lot of companies out there who's looking at fundraising. I think one thing that's not mentioned over here is that, as a VC, we do have a lot of, I mean, there are a lot of times where we become a sponge in the sense where, let's say, our portfolio companies, because of the fact that their businesses are growing so fast, there could also be incidents where the founders would be tired, would burn out, or if let's say for example, there are arguments between the two co-founders. That's where we have to step in to also help be a counselor, to help address the tension within the business itself. So in other words, a VC has to be good in everything. Okay, well, we might not be an expert in everything that we do, but we have to be good in everything that we do, and we have to be well-rounded enough to be able to jump in to play different role at different time. Also, that's why for those who are interested to become a VC, you have to be a well-rounded enough person. A bit more high level on how the VC industry works. So in general, obviously, in this case, because we're talking about VC, so venture capitalists, we are in the middle. So think of us as the fund manager. Think of us, for lack of better description, the middle or the middleman between our investors and the entrepreneurs. Essentially, we take money from investors who put we call them the LPs, limited partners, who wants to make money out of this particular industry. In our case, is technology, where these investors would put money into a fund, and we use the fund to invest into entrepreneurs who are looking for funding, who needs a partner to help them grow the business. And then when the timing is right, we'll work with bankers, we'll work with people in the capital markets to arrange for a sale. A sale in the sense where, let's say, for example, if you invest into a Malaysian company and a counterpart from Japan who is in similar industry, who's looking at expanding business from Malaysia, they're interested to buy out the company. That's where we work with bankers. That's where we work with brokers to help sort of facilitate those kind of transactions. Or eventually, we could also get our portfolio companies to go for an IPO. So that's how it works. We are venture capitalists. We are in a way how the money actually flows. I guess, I mean, the biggest skill that venture capitalists have to have is the ability to identify the good type of investors as well as the good type of entrepreneurs who are able to generate the type of return for you. And in a more technical manner, we call ourselves the general partners because we are the management company of the fund. As I mentioned, LPs or limited partners, they are investors who commit capital to invest via the venture fund. So for us, we act as a GP. At any point of time, we could have multiple funds that we want to manage, and each fund would have the different strategy or different type of mandate that they look at. So under each fund, we could be looking at different portfolio companies. We could be investing into different companies depending on the demand from our LPs, depending on what they would like to see. But for companies, for entrepreneurs who are looking to raise funds from VCs, there needs to, I mean, I think with most entrepreneurs think that raising money from VCs is exciting. Of course, it is exciting to raise big money, to appear on news, to appear on the front pages, and to tell people that there are VC firms who invest in you. But one thing that entrepreneurs might not have thought of is that even with partnership from a VC firm, there's always advantages and the disadvantages. The good thing about raising money from VCs is that you not just the wealth, not just the money, you also get access to the expertise. You also get access to the network. You also get access to connections that the VCs can bring to you. A VC firm could be introducing you to your next client. They could also be introducing you to the buyer of a company as well. And of course, because of the fact that it's not a loan, we don't expect you to pay us on a monthly basis or whatever it is. Because when a VC is invested into a startup, we're in it for a long term. We won't expect any payout until maybe 5 years later or 6 years later, sometimes even 10 years later. So that's why when a VC invests in the startup, we are considered to be on the same boat. If our companies make money, that's how we make money as well. And that means that's why I say that we don't expect short-term returns. We don't expect a dividend on a monthly or annual basis because we are in it for the marathon. We don't do a 100 meter, we do a marathon. But the downside of having a VC on your shareholding structure is that it means you won't be able to call the shots 100% of the time. But that's hard to accept, but it's a reality. When a VC is involved, it means that you have one more stakeholder to answer to. The CEO of the company would now have to make sure that he or she has good stakeholder management skills because you need to make sure that your investors, your shareholders are happy with what you are doing. There's less autonomy with your decision making, but as I mentioned, it's an exchange. You're taking advantage of the VC's network and expertise. So what it means is that investors or VCs would have a say to what you are doing to your business. There's always a list of things that a VC would want to see, or will want to have involvement when it comes to decision making. For example, if you decide to sell 50% of your company asset, most VCs will need to have a say on that before you can actually do it. So that's why this is what we mean by a decrease in autonomy. And raising funds is a lengthy process. Lengthy in the sense where we generally advise startups who want to raise funds to start fundraising at least 9 months before your cash run out. So that's why it's important to actually do a good cash flow projection to understand enough about your expenditure, your future cash needs, and try to figure out when you're gonna run out of cash. When you're negotiating a deal with VC, it will take time, and that's why 9 months is a good, it's a safe buffer to have, just in case your fundraising exercise it's too slow. You might need to talk to 100 VC before you get a yes from a VC. So that's why it's a lengthy process. And the term sheets, the deals generally, because VCs are in it to make money, and also because of the fact that we need to make money, we need to protect ourselves. So term sheets are typically biased towards VCs. There's certain control terms that would allow VC to have more say in order to protect our interests. Hence, that's also where it leads to the less autonomy for you. And at the same time, when you get a VC to invest in you, you wouldn't be able to see the value of the VC immediately because it will take time for most of the work to actually become fruitful. This is a show of how we look at companies. But these are just hypothetical numbers, but when a VC is at already has a scale of network, we do look at a couple of hundred of companies per year. That's why we have, in a VC firm, we have analysts who go out there to source for deals, or even the partners source for deals as well. From there, we do an initial screening, we do an initial elimination to only focus on the companies that are relevant to us, because each VC we have our own different strategy, and if you are talking to companies that are not within your strategy focus, then that's where we screen them out, and we only want to focus on the companies that's relevant for us. Then we start going into the evaluation process where we have to do what we call due diligence to see which are the companies we think has potential, which are the good companies. We're going to pick the best companies out of the whole lot of companies that we see. Once we have decided on which are the companies that we would like to proceed with, Then we will go to what we call an investment committee, where we get an approval from the investment committee, and then we go into a full due diligence process where we also involve the lawyers, talk about term sheets, and we talk about how the negotiate the terms with the entrepreneurs, and eventually to actually execute the investment. After that, we would expect more processes on around monitoring. We want to support the business to grow. That's why for VCs, we typically have a periodical update with the portfolio companies, so that we understand where they're heading into. And if I show you my WhatsApp, between us and our portfolio companies, the conversation happens on a daily basis. So for VCs, our time zone is also similar to the time zone or the working hours of our portfolio companies. When they need help, we always need to be able to be there to help them grow. Because at the end of the day, if they are successful, we are successful. For lack of, I think the other way to describe a VC's relationship with the entrepreneurs is that all our portfolio companies are the Batmans, whereas VCs, we are the Alfred or the Robin. We are not the one who's going out there to fight. It is our portfolio companies that are going out there to fight. But what we do are usually behind the scene. We provide the support. We provide the ability for them to have more intelligence, to have more information, so that they can go out and put up a better fight. So that's how I would describe our relationship with our portfolio company. And because of the extensive work, that the extensive value add that we want to provide to our portfolio companies, we generally would only invest maybe 1 to 3% out of the whole lot of deals that we see. So maybe every 100 deals, every 200 deals, we only do 1 or 2 investments. We don't want to invest into 100 companies and then eventually run into trouble of how do we actually allocate time to support each of the companies. So for VCs, it's to actually qualify for VC funding, it is very difficult, given that there's only that much capital that we can deploy, and there's a lot of criteria that you need to be able to fulfill in order to actually get into the network of the VC. Since we talk about how the due diligence process, there are 4 areas that we typically look at when we are analyzing, when we're doing when we are understanding more about a startup, a company who come and fundraise from us. Of course, this is a very generalized argument. Firstly, and we look at the trends, and this has to do with the fund mandate, the fund strategy that VC has. Like I mentioned before, VC has different investment strategy, and when we look at a startup, the first thing that we see is whether this company, whether this team of entrepreneurs, are they looking at the same direction as us? If we believe in the value proposition of the startup, of the company, if we think that they have identified a trend that's, for example, is for the tourism market, that would be a permanent thing, that will be a long-term trend for the next 5 to 10 years, that is a good characteristic, good trait. We want to invest into a team of entrepreneurs that's able to identify a long-term trend that would be able to last or to sustain. Then the next thing that we look at is the business model. Whether the entrepreneurs has figured out the right kind of business model that would be able they would able to employ to actually have a good revenue model, a good way to monetize. Having a good idea, being able to identify the trends is one thing, but we need to see a company or startup or a team of entrepreneurs that is able to actually make money out of it. Because VCs, we are not charitable organization, so we invest within the intention of making money. Hence, the investments that we make needs to be able to showcase that the startups need to be able to showcase that they are able to make money eventually. So that's on the big business model. Then we look at the team itself. Does the team have the ability to leverage their own personal experience, their career, their work experience to build the business? Do they have something do they have a reason to fight? Do they have the passion that we would like to see in an entrepreneur when they're growing their business, when they're going out there to compete? And last but not least, look at the product, look at the actual business and the actual service, the actual product that they build. Is that something that the market will need? There are times where an entrepreneur will build a product where there's not enough users, where there's not enough customers. That is a flag. Because if there's not enough customers, there's not enough users, it could mean that you can't make money out of it, or it could mean that you're just building something that you like, but majority of the people out there, they don't need it. So we do spend quite a lot of time on understanding how does the product look like, and that link, then we can then get back to the business model element to understand how is the whole value proposition is being addressed. And of course, like I mentioned, out of 100 deals, out of 200 companies we look at, we only accept 1 or 2% of the companies that come to us. But what are the reasons? It's typically being put into these few buckets. Sometimes when a company comes to us, if the market that they're addressing is too small, that's where we will tell them that, look, we might like them, but because of the fact that it's so small, so we don't think we can make money out of it. Hence, we will have to say no. Or it could be because of the fact that the market is large enough, but it's such a competitive market and the company doesn't have any competitive advantage. If you're telling me that we are trying to build another Shopee, that's going to be a red flag. Because as much as we agree that there's going to be more online transactions, but if you don't show me how you are able to compete with Shopee, for example, that would be a red flag, because Shopee is too big to go against, and hence, if you don't have an edge, then it doesn't make sense. Or we could also be rejecting an entrepreneur because of the fact that they have not thought through their idea, they have not thought through their business thoroughly. Which is why, when their projections are not reliable, the projections are not credible in the sense where maybe they're being too optimistic, or they're looking at the wrong place. That's also a sign that the team has not done enough homework with the industry. Or it could be simply because the entrepreneurs or the management team is not good enough, or they're not of the right kind of personality trait for us. Or it could be because the investment amount is too big or too small. As I mentioned, most VPs have their own investment strategy and mandate. It means that we have always a range of money that we want to invest into, and if it's not beyond, if it's way beyond what we can do, then we would have say no as well. Or it could be because of the valuation is too high, or because at the end of the day, we want to buy low, sell high. So if the valuation is not something that can be agreed between two parties, we will say no as well. And last but not least, if it's too far away from what we usually look at, if it's beyond the guidelines of our investment strategy, we would also not invest. For I mentioned just now that fundraising from VCs is a long process, and this is really a good slide to show you how much time we might need to spend, all the way from the contact point to end to due diligence processes, and then to negotiate on term sheet. The whole process, as I mentioned, could take 6 to 9 months, sometimes even a year, depending on how compelling your business is, depending on how compelling your pitch, your proposition is. And I think in general, the easiest part is to get to talk to a VC. But what comes next would be the whole process of question and answer, the process of negotiating the terms that will take more time. We have seen cases where everything was good, but when it comes to the term sheet, when it comes to negotiating the terms of investment, that's where things start to fall apart, because of the fact maybe the entrepreneur don't agree with our valuation, or we don't agree with their idea of valuation. So there's a lot of moving parts until you actually sign the agreement and get the money in your pocket. So that's why it's a long process. And without going too much into the technical terms, what what entrepreneurs should understand is that in the term sheet that in VCs issue, there's usually the economic stance, which dictates the financial aspect. But there's also a long list of investor protection clauses which protect the investor, the VC, when we invest into your company. And this is what, when this is related to the point I mentioned just now in the slide where we talk about the disadvantages of raising money from VCs. Because the reason why we have this in place is to protect us against any downfall of the business. Because at the end of the day, the business is managed by the entrepreneurs, so we can't do much about it. And the best we can do is to have protection clauses to make sure that if there's a default at entrepreneurs end, then we are protected against it. Well, not all VCs are the same. By now, I think I have been quite repetitive in the sense that I mentioned, VCs all have different strategy. When a startup look at a VC, or even when a VC look at another VC, we always try to understand what sort of characteristics or what sort of which category do they belong in. We are always differentiated by our geography. There are VCs who invest purely in Indonesia, for example. There are VCs who invest purely in Vietnam. There are also VCs who invest into the region, or there are VCs who likes to invest in China but nothing else. So we are all differentiated by our geography, by our focus of market. We are also differentiated by stage. As mentioned earlier, VC, even within VCs, we differentiate ourselves by looking at different stages. Some look at series A, some look at series B or C. So VCs with different stage focus will look at the business differently. If it's a more mature or late stage VC where they look at, say, maybe investing into companies that are generating, say, $100 million revenue, for example, then they would rely a lot more of their due diligence on their financials. But if you're like us, where we invest into an early stage company, where there's not enough of numbers to run analysis, then our analysis, our due diligence process could be more qualitative, in a sense where we try to do more reference checks on the founders. We try to do more soft studies to understand the industry better. So that's why VCs are also differentiated by the stage. Some VCs will only invest into certain industries, or some VCs might not even care about the industries at all. And the fact that we are all differentiated by stages, by geography, that also that also means that we are all differentiated by the type of check size that we do. Some invest small checks, some invest larger checks, some invest larger checks, but they have a minimum size, which means they are not allowed to look at the younger stage of companies. So that's where it's all different. For entrepreneurs, for startups who are raising money from VCs, it's good to also be able to understand about the background of the partners. What can they bring? What can the VC firm actually bring to you? What kind of network do they have? What kind of style do they have? Are they an active investor or a passive investor? I mentioned before, some investors are passive in the sense where they put money in you and then that's it. They'll leave you until the point of time where it's time to collect back their money. There are some investors like us who come in to help you build your business. They are more active, and that's where you need to decide whether you want a partner who's constantly helping you, and also you could call them busybody as well. So we are all differentiated by that. And one last bit to look at is actually two more things to look at would be on the fund life. Because for VCs, we manage a fund, there's always a duration. A fund could be an 8-year fund. If you're talking to us when the fund is already year number 5, then there's no point, because in year 5, you will not invest into any new companies anymore. So that's where entrepreneurs need to understand as well, whether the fund that the VC is managing is that in the early days of the fund, or already at the latest stage of the fund, where the counter VC is not looking to deploy capital anymore. The last but not least is to understand more about the portfolio companies that the VCs have invested. VCs, you could understand or at least you could understand more about the VC's interest or preference by looking at the companies that they have invested before, to understand more about what kind of interest do the VC have. Or you could also do a background check on the VC by talking to the portfolio companies that the VC have invested before. So for all VC firms, we have our own what we call deal source. Deal source in the sense where these are channels of us in seeking out for investment opportunities. We do get introductions from our personal contacts. There are people who maybe are our personal mentors or peers who have who come across a particular startup that they think it's interesting, and then they introduce to us. Or we could get advisors or professionals who actually knows a lot of companies. Then they can also bring those companies to us where we actually can do due diligence after that. Our portfolio companies would also introduce potential investees to us because they know that we are looking at a certain industry. They know that we're looking at a certain type of companies. That's where our portfolio companies would also make the reference call or or make the introduction to us. We can look at we might work with intermediaries. We might work with industry gurus where they understand the industry so well that we rely on them on advice or tips to look for good companies to look to invest into. Or we could also get deals by getting cold calls, by getting cold emails from entrepreneurs who are looking to raise funds. So these are some of the channels of how we actually get access to deal flow. All in all, I think this is also in a way where we prioritize on the type of companies that come to us. If it's a company that comes to us because of the trusted source, then we definitely want to put more attention into those companies because we believe that our trusted sources would have done some level of due diligence on the company, and hence it will be a safer bet for us. So we do actually rely a lot on references. And when we receive a deck, when we receive a recommendation to look at the company, there are certain areas that we look at. Firstly, we look at the problems. What kind of problems are they trying to solve? Then we look at the product, market sizing, customer acquisition, etc., etc. So these are some of the very high level of the areas within a pitch deck that we would always pay more attention. The problem itself, I think, for the first key component of the pitch deck, we always like to see what are the main pain points that you're trying to address. What is the key value proposition of your product, of your business? How actually how okay, so the first thing is what is the problem? Then how do you actually solve it? What is your value proposition? If your problem is not solving any problem, you can solve it for a of opportunities like, because generally speaking, there are two type of companies. First type is a problem solver where you are building a business to solve an existing pain point. The second type of business are the types where you actually explore and expand on new market or new opportunity. This is what people usually call the blue ocean businesses. So there's no right or wrong. There's no good or bad between the two. But for VCs, we want to see a clear theme of your business. What kind of value proposition do you provide? Once we know about the problem, once we can see a clear illustration of the whole theme, the objective of your business, then we zoom into the product itself. How do you actually solve the problem using your product? How do you actually how are you different from the existing products that's available in the market? In essence, we want to know what is so different about you, what's so innovative about you. How can you become successful in a sea where there's so many competitors out there? If you have a prototype, if you have a demo, that's where this is a good point of time to showcase as well. Because visual understanding is easier than just reading words. So we want to see examples, we want to see showcases. And we definitely would love to see or hear more about the product lineup. We don't expect any startups to be able to build the product that's perfect in the first place. We expect evolution, we expect pivots, We expect an entrepreneur to continuously make changes to the product to improve the product itself. That's why for us, we want to know what is the future plan. If you're looking at expansion, which market are you going to expand into? If you're going to add more features to your product, what is your expectation? How are you going to be able to enhance your product as time passes? When do you exactly plan to do it? So it's good to showcase all these elements under the product section. Then after that, we will zoom into the money monetization part. When we are clear about the product that you already have, we will start asking you, or at least we want to understand from your pitch deck about your business model. It's good to have a product, but we want to know that you have a product that you can monetize, or you know that you know of a way to monetize. Like I said before, and I have to repeat again, VCs are money guys. You need to show us the money. How do you plan to make money out of your product? Who are your customers? How are they paying you? Are they paying you by subscription? Are they paying you by once off? Are they paying you by other methods? So we want to know how do you want to monetize and how much can you monetize eventually. And that's why to show clearly how do you actually make money with your revenue model. Once we understand that, we want to zoom into your customer, your actual user. Who are your actual users? How much do you think? How large of the pool of users do you think you can access to? This was where the TAM, the SAM, and all those kind of terms will come out. And we want to know your target market. Who are the type of consumers that you want to acquire, and what is your strategy in acquiring them? Essentially, your marketing strategy, your sales strategy. How do you plan to attract their eyeballs? How do you plan to make them spend, and how do you actually retain them? And with all those, we want to know the cost. How do you actually look at costing to acquire customers? This is where terms like CAC, customer acquisition cost, comes into place, where we will compare your CAC, your customer acquisition cost, to your revenue model, to your long lifetime value of each of your customer, to make sure that to actually see whether are you generating profit from every transaction that happens on your platform. So customer acquisition, you want to know who are your customers and how do you plan to keep them. So again, this is just to illustrate the sales strategy, the marketing strategy, the cost, etc. And there are times where people will put this upfront. So it depends on how you create the flow within the presentation. But definitely, VC, we want to see your thoughts around market sizing. To be honest, I don't really give much attention to this particular section because most entrepreneurs who come to pitch to us, they will always say that they are in a couple $100 million US or a couple of billion US kind of market size. All these numbers don't mean much to me actually, unless you can dissect it to be more specific for your business. Because if you're telling me that you can address the Southeast Asia market, yes, Southeast Asia has maybe 600, 700 million people, but we don't, realistically speaking, we don't expect you to be able to conquer the whole 650 million people in Southeast Asia. So we want to see more specific data, and we want to see more specific assumptions that addresses your company, and why do you think this is a market that will be profitable, and why do you think this is the market that you can conquer right now? So these are some of the examples. Yes, the TAM, the SAM, the SOM. So all these are terms that you should use to address the question around market sizing. So the next thing to look at, we would also want to understand about your competition. For VCs, being able to if you are able to provide us an honest assessment of how you position relative to the rest of the industry, and to be able to understand, I mean, to let us know that you understand who are your competitors out there, that is actually a bonus. There are times where entrepreneurs would try to hide the fact that there's competitor A or competitor B in the market. It doesn't work because at the end of the day, we don't take your word as it is. VCs would always go back and do our homework to do our own research as well to understand how does the landscape look like. So rule of thumb is entrepreneurs should always be honest with sharing with us who are the competitors out there. Whether it's indirect or direct, there is it's a taboo to actually purposely omit the existing competitors that's already in the market. This is the part where you want to focus on your competitive advantage and how you differentiate yourselves relative to the competitors. I think most important takeaway from here from this section for VC is that we want to know that you understand enough of your market. We want to know that you have done enough homework to understand your competition out there. So that you know you actually know what sort of strategy to actually pull when you're actually going head on against them in the future. And usually these are some of the slides that we get to understand more from our entrepreneurs, from the entrepreneurs. How do they look at themselves relative to the rest of the companies? And I mentioned before, team is very important. So we want to know more about the people in the company, not just the founders, not just the management company, but we also want to see if you have a board of advisors and who's on your board as a director. How are each of the directors, how are each of the board members supporting your business? We want to see whether you have the relevant kind of experience or skill sets that could contribute to the growth of the business. Generally speaking, we also want to know about your team strength. Team strength in the sense of how many people do you have, how much are you spending to keep the team, and how what are the roles and responsibilities that each of the team members play. Because at early stage company, and when your company is still early stage, the each of the members would have more responsibilities. So we want to know more about the team itself. So these are some examples of how you should showcase. But of course, that is just examples, so there's no best way to showcase. The next bit that the VCs will look at is to zoom into your financials. There are two parts of it generally. One part is to look at your historical numbers. Basically, what have you been doing, your traction essentially. Have you been generating profit or have you been generating losses? If you have revenue, how much was the revenue? What was your growth? And the second part is your projections. What do you expect the future growth is for your business over the next maybe 12 months? And in I think all in all, VCs would from experience, out of 10 projections, 11 of them would not be accurate. But what we want to see from your projections is to understand about your thought process and also understand whether you are being too overly optimistic or you're just being, I don't know, delusional. If you're telling us that you're expecting a 200,000% growth next year, that's to me, in short, it's kind of a bullshit because we've never seen such a growth before. So definitely there's some benchmarking that we always do to compare your business to some other businesses that we have seen to be able to come up with a reasonable expectation. And hence, financial is important for us to understand about your thought process, about your assumptions, why you come up with the assumptions, and how do you plan to sustain a business given the kind of cost that you have. We want to know about your future plans. If let's say you can't raise money, how much do you spend right now, and can your current cash or available cash be able to sustain the business growth? So we expect this sort of presentations. And I think one of the last bits we definitely would like to know is how much money are you looking to fundraise? This particular component has a lot to do with your financial projections, your financials. Essentially, we generally advise entrepreneurs once they raise funds to think about how much they want to use in the next couple of months. Do they expect to use a lot of money for marketing soon? Do they expect a large surge of spending soon? And with the kind of spending, what sort of upside do you see? What do you think your conversion from expenditure to revenue is? So from there, that's how you come up with the amount that you want to raise. And with that funding amount, how do you plan to spend it? And what do you actually think your funding round could result in essence? We want to know, after we give you the money, how much growth do we expect to see in your business? And that would also sort of build a foundation of the discussion around valuation. Because when we know how much you want to raise, then we would want to understand from you what sort of percentage of the business are you giving out. In other words, we want to be able to price your company to understand whether your company is worth how much your company is worth, and then make an assessment to understand how much growth do we expect to see, so that we can justify the risk that we're taking to invest in your company. So these are some of the examples. And yes, this is just to illustrate the additional questions that VCs might ask. Market size obviously will delve deeper, but what I want to illustrate more is your technology and your strategy plan. So for technology bit, if you are a very tech-driven company, we expect to see more elaboration on your tech stack as well. How does your tech work? How differentiated is your technology? If you have patents, do you actually want to patentize to actually get a patent around it? And what sort of timeline are we looking at? The rest of the slides are pretty much repetitive. I think this is a long slides that I built, but maybe let me jump straight into one of the last bit that I want to talk about. On top of questions from VCs, we generally also expect startups to ask us some questions as well. Some of the questions that we expect startups to ask are things related to, what's the ticket size? Because if, let's say, you're raising $1 million US and the VC can only do 200,000 at most, that means you need to look for the additional $800,000. Knowing this answer would help you understand more about the time that you want to allocate. Do you want to allocate more time spending with this VC, or do you want to move on to look for a next VC? Or if you like this VC, you need to understand how many more VCs you need to get, how many more co-investors you need to get to be able to fulfill the round. What is the timeline? You should ask about what is the timeline as well, because each VC would have different timeline. I generalize it by saying that it will take 6 to 9 months to fundraise. Each VC would have different timeline because of the pipeline that they have, because of the resources they have. And if the VC is taking too much time, then an entrepreneur should just move on to talk to another VC. You don't want to put your eggs into one basket. Whether the VC sees you as a good fit or not, you should also understand that from your VC. Is there any competitive nature within the portfolio that we have invested? If the VC has really invested into something that is in competition with you, then you might want to think twice of how you want to talk to the VC, or whether you actually want the VC to invest in your business or not. Because it's always bad. If VCs are putting two horses in the same race, then it means that the VC is hedging their position. It means that they might not be giving you the full value add that you're supposed to get. That's why you want to know, how would the VC actually work with portfolio companies, and whether they are ready to put in more resources or more value add or not. And I think some of the last questions that we should ask as entrepreneurs should ask is that, what are the criteria that VCs would look for to invest into a company? If the VC have a clear guideline, a clear answer to that, then you know whether you are a good fit to the company, to the VC or not. So yes, that is about it from me. I definitely would love to hear if you have any more questions, given that I've been talking for last 1 hour plus. Would be good to share some questions and actually have more discussions as well.
Thank you so much, Victor. Do we have any questions?
I actually have one from Victor.
Okay, Albert, go ahead.
It's a general one. Victor, what I wanted to know, what are the popular type of field sectors, area, industry that VC is actually actively looking at for year 2021 and also for the coming year 2022?
Well, that's a very broad question. But there's also a question that we are all asking ourselves now. Given that there's still COVID, given that there's still a lockdown and everything in different countries, it seems like there's a lot of moving parts. But if I may summarize it and generalize a lot of things, obviously there's all assumptions in place. I would think that areas around mobility, areas around logistics or supply chain would still be, a very, very good investment area for this year and next year. Because that's something that will still be growing. It doesn't matter how COVID turns out, it will still be a growth sector given that the demand for that is not going to come down. People are so used to buying online, for example, you'd expect more logistics capacity needed to be built in order to fulfill those demands. We are no longer just relying on offline consumption. So companies that are addressing the digitalization of traditional businesses, those would be good areas to at least safer bets to invest into. But in general, yes, any sort of digital companies or tech companies that are addressing those matters would still see growth despite COVID.
Okay. Okay. Another question, just to add on my previous question. What do you think about this online learning platform and whatnot? Is it still favorable, or it's already over? I mean, in terms of the trend.
I think it's if you asked me a few days ago, I would think that it's very positive. But right now, it's a little bit hard to say because recently we just saw China did a crackdown on edutech companies, and a lot of investors lost or potentially going to lose their money, billions of dollars, because of the fact that Chinese government is trying to convert, at least from what I read, convert all these edutech platforms, online learning platforms, into non-profits, which means investors who invest for profit reasons now they're gonna be worried about how do they retrieve their capital eventually, because if these are all non-profits or not supposed to make so much money, then there's very limited upside to what the investors could get. But yes, for other parts of the world, I think online education is still a growing trend. But what are the recipe to make it successful? I mean, I'm not too sure. For us, we don't look at edutech that much at this point of time, because it's still a very competitive market. Traditionally speaking, education is a very hard sector to crack. Personally, my first ever so-called business or startup was about education as well, and and I did miserably. But this was more than 10 years ago. 10 years ago. So education, yes, it's still a sector that we should look at, but it's a very difficult industry.
Victor, just to ask, how did you venture into becoming a VC? How did you start off as a VC? I know we shared your bio, but probably maybe there's a backstory to it.
I think it's that within our industry there's a saying that if you fail to be an entrepreneur, you become a VC. So that's what happened to me lah. Since I can't be an entrepreneur, but technically speaking, starting my own VC firm is an entrepreneurial journey as well. But if you can't do anything else, then you become a VC. That just you got your learning point from all your failures, and then you can pass it on to the companies that you invest into. Like right now, I could share my failures to my investees as well. So that's in a way why I became a VC. But in general, I think it's just because that I'm lucky enough to understand what I wanted to do early on. Unlike a lot of my peers back then, they were still figuring out, what do they want to do in the future. But I already know what I want to do. So for me, it's a clear direction of, going to VC is the best choice for me.
Okay, all right. Do we have any questions from any of the students, maybe, or participants?
I think this is a tough topic. Okay, Victor, you might have shared something about it, but my colleagues here know that I have my second dose of AZ yesterday, so I'm still very, very blur. Actually, I think some people might have a perception that now if I'm rich, I can be a VC. So I have fun investing my money in other people business. So I make other people rich and I get richer. Is that true?
Money is definitely something good to have. It's definitely very important in the VC world because we need to raise money from people who has money as well. But what people don't realize, I think, let me share this screen again. I think you see this screen right now, right?
Yes.
This is a nutshell, but not. I mean, it's maybe 70% of the truth. Are the things that we need to do when we invest into a company, and we have a long, stringent process that we need to go through in order to find one good investment out of 100 or 200 deals that we see. So if you're telling me that you have money and you're willing to do all these things, you're willing to hire people to run the whole process, and you leading the whole process, then maybe you could be a good VC. But all in all, I think to answer you, it's you need the right kind of skill sets. VC venture investment is a long-term process. It's a marathon. You learn from each of the investments that you make. That's why when we talk to our investors will also ask us, what are your failures? What have you invested that did not work? What are the learning points? So all these are like our battle scars. So you know when you go for war, the more scars you have on the body, it shows that you have fought a lot of wars. You have won a lot of wars as well because you're still standing there. So we need to have all those experience before we can be, a good VCs. So I think to answer your question, yes, maybe not because you have no experience or you don't have the capacity to run a platform. That's why people with money invest into VC funds because we are the one who's doing the hard work and they are committing capital since they have excess capital to just make money out of working with us.
Okay, Putri, let's just go through the question in the chat box first.
All right. Okay. So there's a question from Johan. He asks, what is your insight on blockchain?
Oh, that is a question that it's hard for me to answer because we don't invest into blockchain related companies yet at this point of time. Not because we don't believe in blockchain. We do believe in blockchain, but if you're talking about blockchain in the sense of crypto, then we probably won't touch. In essence, we do think that blockchain has a very good long-term story. But until then, until we are able to lower the costs on R&D in blockchain, we wouldn't want to invest into that area yet. Unless it's something very compelling, yeah. Otherwise, we wouldn't want to do it. Because in Asia, in regions like Southeast Asia, the cost of labor is still very low, relatively speaking.
Yeah.
So blockchain might not be the most cost efficient way of doing business. And plus, there's not enough data online. Blockchain relies on the mass of data available on the net, at least on digital form. But we don't have that yet. So I think blockchain would come later, but not immediately.
Okay. And then we have a question from Hafizuddin. What's the typical age and background of the startup team that apply for VC funding?
In general, based on what we saw, I mean, what some of the publications in the US, it used to be like 40 plus on average. I mean, the successful ones now. I don't think there's a typical age or background. I've seen as young as 18 years old. I mean, the youngest I've invested before is 18 years old, but the founder is rich. He has a very good safety net. So if he fails, he can always go back to his family business. But thankfully, he has proven himself to be a good entrepreneur. He's still running the business after 4 years. Now he's 24, I think. Sorry, 6 years. So he's still running a business. He's still growing business. But that's a rare case. Looking at our portfolio company, on average, the entrepreneurs who apply to us, who actually submit their proposals, and then we eventually invested, it's around 30-ish. So that would be the average, age, at least within our portfolio companies. Because Yeah, I think in general in this region, entrepreneurs are pretty young, unlike the US, unlike China, where there's already a second or third wave of entrepreneurs. Over here, we are still in the first or 1.5 wave of entrepreneurs. So that's why the average age is still younger.
Okay, all right. So, Faik had a question. Is Pershing Square Capital Management similar to VC? If not, what is
Um,
the
I
difference?
I think that it's more of a hedge fund rather
Ah,
than a
okay.
VC. A hedge fund, they have their own different strategy, and they could be investing into listed stocks as well. There's long short strategies, whatever it is. But they could also be doing VC. So you could think of us as both in the same alternative investment market, just that they might be investing into the broader spectrum compared to us, whereas we're specialists in the private markets or in the private assets.
Okay. And we have a question from Vivian. What is the best way to network with all the investors and VC? How to find them? Yeah, how to find them?
You have one here.
Well, I mean, you could go for such a event and join the next A summer program, or I mean, whatever that MU is going to organize in the future. But right now, this is not an easy way to network. In the past, there's always gatherings, events, conferences where it was much easier to meet people. Now you can't, because physically you can't, go out there to meet unless you want to, to violate the SOPs lah. But what we see right now at least is that there's more and more virtual events that's coming up. Platforms like AirMeet, they allow you to do, what do you call it, networking as well. Obviously, it's not going to be as effective as how it was in the past. Physical is still the best, but if you want to get access to VCs, the best way right now is to talk to companies who have already received funding from VCs and get them to make an introduction, get to know them from other social events, social networking. You have to dig left and right and center. So there's no straightforward answer to that because we don't have the physical gathering option anymore.
Okay, so best way is to make a lot of friends and try and get them to intro you.
More friends is always better.
Yeah. Okay, so Songket here is asking, what is your definition of long term? Are you willing to fund project that won't be making any profits in the short, medium term, but definitely will be profitable in the long run?
Generally, out of 10 investments that we make, 9 of them would not be profit making, at least in the first 3, 4, or 5 years of their journey. I think we don't look at, or we don't evaluate a business based on how much profit we expect them to make in the next 3 to 4 years or 5 years. We look at the possibility of the company to last long enough so that we can actually make money by selling the company to someone else, or by bringing the company to IPO, or to the public markets. So we look at it from that standpoint. The more important metrics to look at is sustainability, whether you are able to sustain a business to a stage where, even without fundraising, you could still grow your business. You could still actually create growth story for your narrative. So I think that is more important. And for us, because VCs, we have a timeline, we have a time expiry date. For most funds, it will be generally less than 10 years. If we invest in you, we want to make sure that we can get the money before the end of the fund. So that's, to me, the so-called long term. But definitely, the intention is to see growth while we are still a shareholder in the company. So that, because we need to sell the company, our stakes, at least our shares, before the fund ends.
All right, right. Can you share the range of percentage of shares that you own in your portfolio company?
On average, there's always a rule of thumb that I have. We don't want to take more than 20%. We never try to take more than 20%, because if we take more than 20%, we are like so big in the company, and it means that we have more commitment and obligations. And if we can't fulfill it, it's unfair to the entrepreneur as well. And plus, we also want to make sure that the founders have enough shares to dilute in the future. because they need to raise multiple rounds of funding. So we don't want to take too much right now, and then that will affect their future rounds. But we do have a range like between 5 to 20%. That's the range that I will actually look at. Below 5%, if most of the time it doesn't make sense. So it really depends on case by case. But if I have to put a range, it will be maybe 5 to 20%.
All right, so we have a question here from Hafizuddin. What is your opinion on Grab changing their headquarters from Malaysia to Singapore? And do you think similar things will happen to Custom?
Okay. I think Grab has to do what they need to do to grow. If by changing their headquarters from Malaysia to Singapore, they get funding from Temasek and everyone else, yeah, it's a good move. I mean, depends on what hat I'm putting. If I'm putting a hat as a business person, as a VC, I think it's a great move because they managed to get more funding because of that move. And if they know that they can't get any funding from Malaysia, then unfortunately that's Malaysia's loss now. We can't claim them as a Malaysian company because we're not supporting them good enough. So it's a good move, I think. Whether Custom is going to do the same thing, I mean, it's still hard to say at this point of time. Right now, because of the fact that we missed Grab, we can't say that Grab is a Malaysian company anymore. We have a chance to make amends. It means that now there's an opportunity of window of opportunity for the local funds, local investors, local government to support Custom. So if there is enough support, Custom would not move. Why would Custom want to move to Singapore? I think the company has to do what it takes to provide maximum value for the shareholders, for the stakeholders. So in the future, if let's say Custom move, yeah, if it's a commercial decision, that's unfortunately the case now. So it depends on how much we do as an ecosystem to support the company. I mean, it's a little bit political, but I mean, I don't really care about politics as long as it makes money. It's not like I'm the PM. I'm not PM, so I can't say too much.
Okay, that's interesting. Any other questions?
Victor, while waiting for them to put in more questions, just questions that I always curious. How you all find investor to put in money?
Oh, same way
If you-
on how same with how entrepreneurs find VCs. We have to rely on introductions. We have to rely on our network. We have to rely on events. We have to rely on people we know, or we have to rely on our investors to introduce more investors, or we have to just approach companies, or we have to approach high net worth or corporates for investment. So it's similar. The biggest difference is that a startup has a product to sell, whereas a VC, we are selling a story. So we have to be a damn good salesman to be able to raise funds.
So that means at the initial stage, you will pick out the 100, 200, 1%, 2% of the startups. And then do you find the investors first, or do you pick out the startup first?
It's an ongoing process that happens at the same time.
Okay.
Definitely we want to, I mean, just personal experience, because when I first started, I already know what are companies that we want to invest into. So which means we already have the deals, we already have the companies. So that at that point of time, the focus was more on fundraising to look for investors. So that's where we can tell our investors, potential investors, these are the companies that we want to invest into. If they like it, if they like our strategy, then they'll invest. So it usually starts with having the deals first, having the companies first, before we can get investors. Because investors, generally, we don't like to invest into black box. So if they don't know what they're putting the money into, it's going to be hard.
Okay, all right.
Okay, Victor, another question, maybe a little bit sensitive. I think over the last 2 years, when we run the centers and so on, we were repetitively reminded about due diligence and so on. So I think there is the same pressures that you have when you have investors to put in money as well, right? So whether the money is clean, where the money come from, and etc. So how, if you mind to share with us how the validation process actually what are the process of due diligence actually happen at that station?
Oh, so you mean how we do due diligence on our investor, is it?
Investors, yes.
Yes.
Oh, okay. That is slightly easier actually, because we work with banks, we work with law firms for the whole process. So if you are working with banks to process, I mean, to understand where is the funding source, then I think it's easier lah. Unlike startups, when we put money into a startup, we have to do a lot more due diligence because they are so small that we need to find more lubangs to understand more about them lah. But for investors, especially the more high profile ones, like for example, one of our investors is MAVCAP. It's easy because MAVCAP is owned by the government, and MAVCAP has a good historical track record of investing into other VCs as well. So at least we know who we are dealing with. It's more of understanding who they are and doing the right kind of I guess cover our ass kind of work to make sure that we do our arm's length research to understand about our investors.
That's been the history of like the hidden rich man individual that don't normally happen in the industry.
Seldom, not so much, because those rich old men might not be interested in this investment because it's perceived as being riskier, and they don't know enough about technology. Unless it's another Robocop lah. If Robocop, yes, Horizon Ventures has invested into a lot of good tech companies, including Zoom as well. But there's only that many Robocop out there lah. So typically speaking, the older generation, they wouldn't be able to understand this particular industry. But if it's their sons, their grandsons, granddaughters, daughters, or whatever it is, the second, third, or fourth generation, those would be more likely to invest into a VC fund or into startups directly because they're younger. They belong to the same internet boom era. So those people would be easier to convince. And by those people, I think it will also be easier to do due diligence on them because they're generally speaking more social savvy. That they have a social account, social media accounts, etc. So it's not as difficult to understand them as compared to understanding the first, second generation.
Okay, Victor. So I think my second last question. Sorry, I'm asking a lot.
No problem.
What happened in the classroom is when we talk about evaluating the worth of the companies and etc. We were exposed to a lot of formulas, financial calculations, and etc. and etc. I remember I took a subject like that. It almost killed me with all the calculation. But based on your sharing just now, I mean, you didn't share much about the technical analysis. It is more on trends, the business model, whether the market is big. So can you elaborate? Maybe you tell us more about it, or whether or not what we learned in the classroom, like the tons of formulas, actually work in the industry.
There are many ways actually to evaluate to price a company, but I don't talk too much about it. It's because if for early stage investments, companies that don't have enough financial track record, it is hard to be able to do a proper for example discounted cash flow method. It's very hard to do a DCF on those companies because they only have maybe 2 years of record. Do you think 2 years of record is a good representation of the company? I don't think so. The projections are not going to be accurate as well because these are optimistic assumptions. So what we usually do is we look at comparables. Comparables in the sense where we try to compare this company A, to their peers in the same industry to understand where are the peers at and how much. If let's say the peers are more mature, you will try to find out how much were they worth in when they are similar to company A. So we do a comparison to compare company A to other companies to see whether they're priced more expensive or cheaper than the rest. Obviously, this is not super accurate, but at least it gives us a good idea of whether we are overpaying for the price or underpaying the price. So that's the easiest way that we look at. The other way that we can use is also a comparable method where we look at their for example their current valuation, the valuation they're asking for, relative to their revenue. So we do a price to revenue multiple, and we compare that multiple to the same multiple of other companies within the same industry or the same country. So we compare to see whether it's overpriced or underpriced. So I think comparable or the comms method is more reliable, relatively speaking, because for any deals that happen in the market, it's a winning buyer, winning seller thing. If there's already deals done, it means that this is an accepted price and valuation by the market. And if this is the market price in a way, then we want to make sure that we know how would of the transaction that we're looking at compare to the market transaction. I mean, hopefully I'm making sense. It's a bit confusing, but comparable. We just compare.
Okay. Okay. Maybe with the last from me. A lot when we talk about venture capital funding and so on, a lot of people are talking about Silicon Valley, where they are rich. You see, I even see that some people say if you want to have a good startup, good valuation, one way for you to do is to go to Silicon Valley and etc. So how is actually the market different? Is it true that there are more money over there?
I do think that there's more money in the US. I do think that there's more money in the more developed markets, because the more developed markets would be able to have a higher risk appetite. So they will invest into high growth companies, high risk companies as well. But unfortunately, if you go to the US and you're not growing a business in the US, it's also tough, because a lot of investors, they prefer to invest into the markets they are familiar with. So if you're a Malaysian company, you go to the US to raise funds, but the US investors are not familiar with Malaysia, or they're not interested in Malaysia, then they won't invest in you as well, even if they have money. And if you're a Malaysian company, you go to the US because you want to raise funds, and because you want to raise funds, you want to expand your business to the US, that also doesn't work, because unless you are familiar with the US market, otherwise you would fail in developing the business over there. So I don't think entrepreneurs should focus on raising fund, as I don't think fundraising should be the main strategy for any entrepreneurs. If you focus on building a good business that can address your market, naturally speaking, I think VCs or investors will come to you. It's better to focus on the fundamental than focus on the fundraising roadmap.
Okay, thank you, Victor. I think that's all from me. Putri will ask Putri will have more questions to ask, I guess.
No,
Actually, I'm just curious. How many here are students, and how many are lecturer staffs?
let me just check. I think
Yeah.
mostly they are students. Let me
Got it,
see
got it.
whether we have any lecturers. So we have a few lecturers here.
Got it,
Yeah,
got it, got
yeah,
it.
we have a few lecturers, but mostly are students. Um, yeah, Sanket, do you have any questions? Okay, so he's thinking. So he's yeah.
No problem,
I
no problem.
I wanted to ask. Maybe students will be curious because they probably think that, oh, okay, so we are not at that level. So we don't know what when we'll be at that level. So probably you'll probably be able to share as a startup. When do you think they should approach a VC? When do you think they are ready? Because when you share the pitch deck, obviously they must have all that information ready right beforehand. But when do you think that at what point, at what stage of their startup that is they should spark in their mind that, okay, this is the time that we should approach VC?
I think to generalize it, when you have a product, when you have user base already, and you're looking for a partner to help you to grow your business, and you're looking for more support for your business, that's when you should go and raise funds from VCs. I said VCs could become your active partner to help you grow your business. So if you think that you're ready to go out there to swim in a bigger sea, or to go for the big boys, that's when you should talk to VCs.
So now, I know a few of us, Albert, Jinwei, have already asked about, what sort of industry or what sort of product, as a VC yourself, what do you think that the students, should probably look at, and at least, have a thought of, the kind of industry or the kind of product or area?
Sure. Well, the benefit of being a student at this age is that you have the I guess the more you can stem out more risk now, because the good thing about running a startup is that if you fail in one startup, you can always come back again to start another one when you're young. Right? If let's say you're starting your startup at the age of 40, for you to fail and then start again, unless you're Colonel Sanders, who started KFC at 70 plus, otherwise, for students, you have the capacity to fail and learn again. I think one of the issue of Asians being an Asian is that we are always taboo. I mean, it's always a taboo to fail. But that's the good thing about tech businesses. You can learn very fast and you can fail very fast. Once you have failed, come back again. You fight, and as I said, having more battle scars is better than a plain vanilla employee type of background. So for students, I don't think I want to suggest any particular industry, because at the age that the students are at right now, the best he or she can do is to learn and get more network. You might not want to start a company right now simply because you don't have enough connections or enough network, unless you are super rich lah. I mean, unless your family is certain people who can bring you value. But if not, unfortunately, you want to start with the fundamentals. Learn enough, get to know enough people. When the timing is right, when you have identified an area, then go for it. I don't think any students should focus on any specific areas unless he or she is passionate about that particular problem or that particular industry.
Okay, that's great. Thank you so much. Do you have any last few questions? If anyone have any, maybe they want to, can they consider you as, a network that they can connect with in the future? Sonke is asking, I'm curious if Vin Capital is just your side income. What if the market is in a downtrend for months? How do you guys sustain yourself in a situation like this?
The good thing about VC is that, well, actually, let me rephrase my answer. There's no time for side income because we don't have enough time. Vin is our main income. We live or die with it. In other words, I mean that sounds very brutal, but we that's my bread and butter. And the good thing about venture capital is that we are not exposed to, like we're not like stock market goes up and down and then we lose or win big money. But because we are investing for longer term trend, we typically have a steadier, income over the next couple of years, as long as we have committed capital, as long as our investors are still, available, or they have committed capital and they don't default, then we're fine. And I think especially this period of time, it's a good time to be a VC. It's a good time to be an entrepreneur because tech is in demand. Everyone starts to look at technology right now because of the fact that the traditional, say, retail businesses definitely are not doing well. So they want to turn into the new sector. And the current global trend is pushing towards technology. So yes, that's why it's a good time for us. So I don't think I need a side income at this point of time. But of course, who would say no to income if it's easy and free? But I don't expect anything to be free and easy lah.
Yeah, but looking at your, the list of things that you need to do in your 48 hours compared to our 24 hours, you're living in different parallel,
Yes. But thankfully we have a team, so it's not just me lah. So if I look back and at when we first started, it was just me and my partner, three of us. So it was quite kelam kabut lah. Every day is a nightmare. A lot of firefighting, a lot of things to worry about. But when you have a larger team, when you have built enough infrastructure, you've built enough processes, whatever it is, within a proper portfolio, then it makes it easier for us to stomach the whole workload.
Okay, all right. Do you have any more questions? Yeah, I think that was amazing sharing lah. I think Victor have touched here and there, right?
Putri, let me ask, not asking, just to tell you, Victor. So what we are currently doing, most of the students in this room are what we identified to be targeted to be grow. And in fact, on Tuesday, we have our so-called initial pitching for their business ideas. And great enough, some of them has been picked up by external mentor, saying that if they were to execute this, the mentors are willing to commit time at the early stage. But MMU side, we will be committing some very small early funding for them to try and see whether they are lucky enough to be successful. So what we found is the so-called our industry partners at that stage, they are very interested in social enterprise. So would a venture capital be interested with social enterprise as well, knowing that money generated might not eventually be kept and grow, but they will put it back to the community and so on?
It depends. So that's the issue with having being tagged as a social enterprise, because if you're a social enterprise, it's telling people that you're not making money and you're never going to make money. But if you're saying that you're an impact business, that will be easier to attract VC to invest, because nowadays there's a lot more impact funds. There's a lot of ESG funds, where all these funds are looking to invest into companies or businesses that are doing good, or they're good for society, good for environment, at the same time has the possibility of making money as well. So I think for students, for anyone within the network of MU, if you're looking about social enterprise, talking about social enterprise or looking at social enterprise, why not flip it up a bit to make it into an impact business? There's always a good balance between making money and being good, doing good to society. So that's where I think it's a shift of mentality, rather than being social, doing social enterprise, or thinking about being a charitable organization. You look at it from a business standpoint, how do you become a sustainable platform where you don't actually have to rely on donations? You have your own income component to actually sustain the good stuff that you want to do. So I think if we shift the focus towards that angle, that would have a much better impact than purely running as a social enterprise.